So hi everyone, it's a pleasure to be here. I do want to talk to you today about markets and monetary policy. And, I do so not without some trepidation. This is obviously a vast and complicated topic about which we still know very little. This trepidation might be best reflected in a dream I had. I have to talk about this topic twice this week. Earlier in the week, I was dreaming, in my dream, I have to prepare for these two engagements. Let's review what I'm supposed to be doing. And so I'm looking at an email and it says, okay, great. I need to sing and play the piano. Like, wait a minute, I can't sing and play the piano. Oh no, it just says I don't have to sing. Oh, that's good. I have to play the piano. But wait a minute, I can't play the piano. Why did I agree to do this? So with that, let's just jump into the fire pit here on this topic. This talk is based on joint work in separate projects with some combination of Francesco Bianchi, Martin Letow, and Cy Ma. So the question that we have been grappling with for a while is how and why do central banks affect financial markets? And let's just motivate this question further with some stylized facts. We know that the real values of long duration financial assets fluctuate sharply in response to the actions and announcements of central banks. And, this includes the value of the stock market, which is a perpetual asset that endures indefinitely. Now, if you think about it, that's extremely puzzling from a theoretical asset pricing standpoint. And when we started thinking about this issue, we found no real framework for even contemplating the phenomenon. Consider the fact that the stock market is a heavily forward-looking asset. It gives shareholders a claim to some portion of the discounted expected value of future earnings over the infinite future. And so it's virtually impossible to rationalize facts like in bullet point 1 unless something related to the central bank actions and announcements has long-lasting effects on the real economy. Now, our canonical models for thinking about the effects of monetary policy on the real economy are new Keynesian models, but they would be entirely inconsistent with this. I'll show you that later, because they imply only, the monetary policy shocks generate only short-lived monetary non-neutrality. And there's empirical evidence that appears consistent with this. This is in the classic VAR study of Cristiano, Eichenbaum, and Evans. But then if that's the case, how can it be that monetary policy actually influences long-lived assets? So at this point, it may be useful to look again at this, the extant empirical evidence. And by the way, I'm going to get through some material, but if you have questions, I'd certainly like to hear them at the end. I'll try to make this, an hour or less, and then we can talk about these details. And you can just raise your hand, and I will look for it in the Q&A, the hand in the Q&A of the participants who want to ask questions then. So, let's review this evidence. We have, we know that long bonds fluctuate sharply in response to monetary policy announcements, and there's a bunch of studies here that show us this, as do distant forwards. And, one possibility for this is that for some reason, risk premia fluctuate, and there's some direct evidence of this. That is that there's forecastable variation in excess bond returns, i.e. term premia. These two studies, GK and HS, show us this. But this is for short horizon premia. And so this by itself can't be the whole story, since that would imply small level effects. You need, to explain bullet point 1, you really need long horizon term premia to move. Now for the stock market, we have similar evidence. Short-term return premia respond to Fed communications and announcements. These tight windows around these announcements. And, an early study of this is Bernanke and Kuttner, and then there's been sort of a update of that in Kekre and Lanel, and similar evidence in Pfluger and Rinaldi. Again, these effects are highly transitory, and so they would imply negligible price level effects, by which I mean prices relative to some measure of fundamental value or relative to the aggregate price index. Now, does that mean there are negligible price level effects in the stock market? No. Just pointing to a recent high frequency event study that I did with host Roy Cox and Dan Greenwald, where we were just focused on the COVID period. You know, we looked at March and April of 2020, and we found that 5 announcements by the Federal Reserve led to an 8% gain in the S&P 500, just looking in very narrow windows around those announcements. Hopefully I'll have time to talk about that result a little bit more. So, you know, in this talk, you know, we go back to the question, how and why do central banks affect markets? So in this talk, I'm going to argue that central banks likely have larger effects over longer horizons on the real economy than the extant literature suggests. And so what I'll be arguing is that there is persistent, though not permanent, monetary non-neutrality that operates especially on the real interest rate. And so indeed, our estimates suggest that 2/3 of the secular decline in real interest rates since the early 1980s is attributable to changes in the conduct of monetary policy. The term conduct I'll get to in just a moment, but we can just pause on that for a second, because most of the time when economists think of secular changes in the real interest rate, they have all sorts of ideas in their head about why the neutral rate has changed, and the idea that monetary policy could have something to do with these sort of longer term trend-like behaviors in the real interest rate doesn't usually, you know, it's not something that usually comes to the fore of our minds. This in turn, we find, leads to large, lower frequency changes in asset valuations and stock market return premium. Now, the extant evidence that I just talked about showing highly transitory return premium effects basically misses this, because these specifications, I would say, are misspecified, or put more aptly, they're incompletely specified. They miss an important part of the story, even as they may be capturing a piece that's relevant. Moreover, theories that imply short-term monetary non-neutrality also are misspecified because they incorrectly focus, for one thing, on monetary policy shocks rather than deliberate longer-term changes or shifts in the central bank policy rule. And so this gets to my definition of the conduct of monetary policy. I'm not talking about systematic monetary policy, wherein central banks respond to inflation and output growth, for example, that they surely do. But I'm talking about changes in the policy rule itself. So changing reaction functions, whereby the same inflation and output gaps lead to different central bank reactions over time, or changing objectives, you know, the changes in the stated or unstated targets or goals of the central bank absent economic shocks. And so I'll just refer to these changes in the policy rule as changes in the conduct of monetary policy. Sometimes I'll use the more colloquial term stance of monetary policy. Now we look at this, we document some changes in the policy rule, and we're of course not the first to find changes in a Federal Reserve policy rule, for example. There's been prior research finding such changes, a classic study by Clarida, Gawley, and Gertler, for example, and some other studies here. Most of these studies have emphasized changing reaction functions more than changing objectives, and our work will emphasize the importance of both, using more recent data as well. Now, the changing policy rules, we will argue, represent a channel of monetary policy transmission that is distinct from the usual monetary policy shock transmitting to the economy. Monetary policy shock is an innovation in the nominal rate that is uncorrelated with changes in inflation or GDP growth or shifts in the policy rule. This would be a separate causal channel wherein monetary policy affects the economy rather than the other way around. You know, after all, we can think of these changes in the conduct of policy that can occur solely at the free will discretion of the central bank. These are changes that are likely to be driven by a constellation of factors, some of which are hard to quantify or neatly categorized, and possibly shaped by the unique personalities and perspectives of different central bank leaders over time. Just take an example of this. We can think about Jay Powell's Jackson Hole speech in August 27, 2020, where, he said a number of things. And first, our new consensus statement explains how we interpret the mandate Congress has given us and describes the broad framework that we believe will best promote our goals. So this first statement suggests that policy rules are influenced by bespoke perspectives of central bank leaders. And then going on, a clear takeaway from these Fed Listens events was the importance of achieving and sustaining a strong job market, particularly for people from low and moderate income communities. Going forward, employment can run at or above real-time estimates of its maximum level without causing concern, unless accompanied by signs of unwanted increases in inflation. We will seek to achieve inflation that averages 2% over time. The emphasized words in these three really are indicative of changing objectives in the policy rule. And then finally, our decisions about appropriate monetary policy will continue to reflect a broad array of considerations and will not be dictated by any formula. So direct evidence and the clearest indication yet possibly that the central bank policy rules are subject to change, and that the central bank of the United States sees it as their prerogative to change these rules periodically. Okay, so let's go back to the question, how and why does monetary policy influence long-lived assets? So here's our research agenda and the steps, and we're just getting started on this, but today I'm going to focus on the stock market, and that's where we're focusing for the moment. The first steps we took in a paper with Francesco Bianchi and Martin Letow. I'll just refer to that as BLL for short. I'm going to spend most of my time talking about this because it really sets the stage. It's already completed. I'm not in the habit of talking about published work most of the time, but in this case, it really does mark the beginning of a research agenda on markets and monetary policy that we are embarking on and that I hope others will contribute to as well. So I think it's the right place to focus. Now, in this paper, we present new empirical evidence for the stock market regarding changing monetary policy rules and their implications for the stock market. And we have a new framework that's consistent with the evidence. So that's what I'll touch on here. Now, the next steps that we're actively working on right now is to try to understand better what news is in monetary policy announcements and how might it be related to the evidence in that first bullet point that we talked about, and to the evidence that we have here about changing policy rules. And so I'll say a little bit about what we're doing there. This is really still work in progress. We're running estimations as we speak with Francesco Bianchi and Simon BLM. And here we'll obviously connect to a growing literature that attempts to identify the types of news in Fed announcements. So, how and why does monetary policy influence long-lived assets? Well, one possibility, one that we have actively considered, is that there is a component of monetary policy that has long-lasting first-order effects on the aggregate economy, on real interest rates, and the stock market, even if identified monetary policy shocks do not. And so here we're presenting new evidence that there are quantitatively large, decades-long joint regime shifts in some measure of asset values relative to macroeconomic fundamentals, and the real federal funds rate minus a widely used empirical measure of the natural rate of interest, or the neutral rate, as Powell likes to call it, R star, and we will call that the monetary policy spread, or MPS for short. So that's think of it as the real federal funds rate minus this neutral rate. And so dovish regimes are those with negative values for the MPS. We find coincide with persistently high asset valuations, low stock market return premium. Conversely, hawkish regimes, those are big positive values for the MPS, are associated with persistently low asset valuations in the post-war period and high stock market return premium. Now, let's just take a look at the real interest rate and the monetary policy spread over time. Again, the real interest rate is the difference between the nominal federal funds rate and expected inflation. We can compute that in a number of different ways. It's just a statistical measure of expected inflation. The monetary policy spread then is defined as the real the R star, which is the neutral rate of interest for actually the Fed funds rate from Laubach and Williams. This is a purely statistical measure of the real interest rate that should be holding if there's no expected change in inflation. So You know, what we see here in the data, the real interest rate, there is a, you know, and in R star, right, this measure of R star, there's a secular downward trend in R star over R sample starting in the early 60s, and in the real interest rate since about 1980, not over the whole period. In fact, we see very low real interest rates in the 60s and early 70s. And if you look at the monetary policy spread, which is the difference between the two, we might have expected these deviations to be relatively transitory, right? The deviations from zero. Instead, what we see is that the monetary policy spread deviations from zero last for decades. So we have accommodative, long periods of accommodative stance and long periods of a restrictive stance. So what are we doing? Well, we then estimate joint regime switching system for asset valuations and the NPS. Now, for asset valuations, you know, in this paper BLO, we talk about other measures as well, but you know, we focus on the log quote unquote wealth ratio. This is negative CAY or K from an older paper of mine with Martin. And you know, what is CAY? Well, A is household net worth, and it's these are all in real terms. And then what this is relative to a stationary linear combination of aggregate consumption C and labor income Y. So this is like assets over measures of fundamental value in the aggregate economy. It is dominated by fluctuations in the stock market because that is the most volatile component of household net worth. And it picks up more variation in expected stock market returns or forecastable variation in excess returns than other stock market valuation ratios. And since we're interested in the Fed's role in changing expected returns, we want to focus on this particular valuation ratio. So we estimate a two-state Markov switching regression system with synchronized regimes for the MPS and this CAY, and I put an MS here to indicate that the means here are allowed to shift with a two-state discrete valued random variable C that has two regimes, so high and low. So what this table is showing, you keep in mind that the MPS is the real interest rate minus the neutral rate. So a dovish period refers to the low MPS regime, which is on average negative, and the hawkish period refers to the high MPS regime. So what you have here is regime subperiods that we estimate. So the overall sample is divided into estimated regime subperiods using something that's called the most likely regime sequence. And we see that the first hawkish regime subperiod prevails for a long period of time from 1978 Q4 to 2001 Q3. And 78 Q4 is just before Volcker was appointed in August of 79. And in this time, you know, the smoothed probability of a high MPS regime is virtually unity. Okay, so by contrast, the pre-78 period and most of the post-millennial period are dovish subperiods where the probability of the MPS regime being high is virtually zero. So the hawkish regime briefly reappears here between 2006 Q2 and 2008 Q2, following a string of 17 Fed funds rate hikes by the, you know, that began on June 30th of 2004 and then ended with the nominal rate standing at 5.25% on the 29th of June of 2006. And then the target rate remained above 4% until January 2008 when it was lowered to 3%. So these are regime subperiods. Now, if you look again at the monetary policy spread, and the data is in black dotted lines, and this wealth ratio, what do you see? Well, you see, you know, here are estimated regimes, right? So the regimes are hawkish and dovish and dark shades and light shades, and that'll be true throughout the talk when you see a dark shade, that's a hawkish regime that we've estimated. And these are the regime averages in blue. And so across these hawkish and dovish regimes, you see that the MPS fluctuates sharply, right? These are large changes around distinct means over 5 subperiods. And then the mirror image of that is the fluctuation in the wealth ratio. This is like asset values over some linear combination of C and Y. And the high wealth ratio subperiods coincide with low margin, low MPSs, And conversely, the low wealth ratio subperiods coincide with the high MPS subperiods. And so we can see that clearly here. And we've also labeled several narrative events in monetary history here. You know, the first occurrence of the high asset valuation, low NPS regime occurs in the 60s and 70s. It's a period of low real interest rates. And, you know, there are a number of researchers that have concluded that monetary policy failed to react aggressively to inflation in this period. So we labeled that the Burns accommodation. That's after Arthur Burns, who chaired the Federal Reserve over much of that subperiod. Of course, real interest rates shot up and the MPS shot up under the Volcker disinflation and remained high for a prolonged period of time, even well after inflation actually came down. And then we see the beginning of the second appearance of the high valuation, low MPS regime. We've labeled the Greenspan put. You know, this is after the perceived attempt of Chair Greenspan to prop up securities markets in the wake of an IT bust, a recession, and the aftermath of 9/11, at lowering interest rates and allegedly resulting in, you know, perception put protection on asset prices. And so this high valuation, low MPS regime continues through most of the post-millennial period, including, you know, the end of the sample, which overlaps with the explicit low for long policies under Chair Bernanke that promised in 2011 to keep interest rates at ultra low levels for an extended period of time, possibly longer than warranted by a 2% inflation objective. All right, so we labeled these, you know, these types of narrative events are a good motivation for infrequent shifts in the policy world. So I just want to show you that we also estimate there are changes in market return premia across these regimes. And, you know, we estimate that with a Markov switching bar. We impose the regime sequence. And so all parameters, though, are freely estimated, including a transition matrix. And, you know, when we do that, and what we're showing here in blue is the estimated present discounted value of future excess returns for the aggregate stock market. And so that's what this PDV is, okay? And that also, because it's a Markov switching bar, we can take into account the likelihood of a future switch, right? We're looking back on the sample and we know roughly how long these regimes last. And so if you've been in a regime for a while, you know you're likely to switch out, and that affects these estimates. But what you can see is that, you know, here we are with this thing. Return premia fluctuate around distinct means across the dovish and hawkish subperiods, right? And so we have the high return premia in the hawkish subperiods, and conversely for the dovish subperiods. The posterior probability that the present discounted value of these return premia are lower in the dovish regime is 0.81. So the data clearly want push for a particular interpretation, which is that hawkish regimes are associated with high return premia in the stock market. Okay, so we're going to keep that in mind and try to figure out what this all means. We need a model, right? We need a model for at least three reasons. First, we want to explain the previous findings. How is it that the Fed's target interest rate in real terms can deviate so persistently from the neutral rate of interest? Second, how much of, if any, of these findings are actually attributable to monetary policy, even in theory? After all, you know, the canonical New Keynesian models would be entirely inconsistent with the previous evidence. So how do we even theorize about these findings? And third, we want to estimate the impacts, right? So the quantitative importance of the impacts, if any, of these regime changes in the conduct of monetary policy on real variables, on asset valuations, and on stock market return premium. So to do that, we are going to study and introduce a macrofinance model of monetary transmission that has two blocks that describe the behavior of two types of agents. One will be investors, and you can think of these as sort of akin to a wealthy household or a large institution. You know, they represent a small fraction of the population, but own the vast majority of the highly concentrated financial wealth. They take macro dynamics as given because they're too small to influence those, but they are the important actors in, you know, markets like the stock market. Households, on the other hand, can be considered basically workers. We do allow them to invest in bonds only. And they have, beliefs that are key drivers of macro expectations, like expected inflation and GDP growth. Now, you can ask, why do we have two agents? Well, on the one hand, the motivating evidence that I've just been talking about started with suggests that changes in the conduct of monetary policy have persistent effects on the real interest rate. But that's going to be very hard to rationalize unless macro expectations are subject to substantial inertia. On the other hand, financial markets react swiftly to central bank communications and actions that suggest little inertia in financial market expectations. So we reconcile these seemingly contradictory observations by considering two different agents. All right, so let me just quickly go through the equations in this model. The representative investor has income from two assets, which just simplify it to that, the stock market and a nominal risk-free bond. And in equilibrium, they consume aggregate payout, which we'll denote with D, or in log terms, everything lowercase is logs, little d. And so we assume that, this dividend or payout is just some fixed fraction of aggregate output. Now, so that's going to appear in the log SDF, here. And then we also have a patience shifter in here. That's a time varying specification for the subjective time discount factor. Ensures that investors hold the bond at the rate set by the central bank, which will be on the next slide. Otherwise, this looks like a fairly standard SDF. Beliefs, we see grayed out, the gray shades here are the expectations and variances, conditional expectation, conditional variance under the subjective beliefs of the investor. And I'll get to that more in a moment. And then there's a constant convenience yield, LP here. Why do we have that? Well, this just helps us match a sizable average equity premium, and we can ensure then, by making this constant, that all of the time variation in the equity premium is driven by investor beliefs, which is the central focus of this particular paper. We can free that up, and actually in the next iteration of our work, we're going to allow that to vary over time, but here it's just constant. And for macro, so we have these equations that describe the investor part of the model. And for the macro part of the model, we have what effectively looks like a prototypical new Keynesian model, a la Gali, chapter 3 of this book, that has three Gaussian shocks, which are in green here. So we have a demand shock in the Euler equation, or the so-called IS curve. We have a potential output shock, shock to potential output, and a shock to monetary policy shock. That is an innovation of the policy rule. But there are key differences here. There are three modifications that we make. The first is policy rule changes. So we will allow for, in purple, regime shifts in objectives, here the implicit inflation target, and in the activism coefficients, governing how strongly the central bank reacts to deviations of inflation from target and to economic growth. We also have some inertia in the policy rule. So there's this row here, and that's allowed to shift with this parameter C, which is a Markov switching parameter, the same one that we had before. So we're going to allow for these parameters to shift with the regimes that we've already identified from the simple empirical exercise that we started with, but we will freely estimate these parameters. So there's no implication that they shift at all, right, or shift in the right direction relative to the previous dovish and hawkish regimes. Now, the second thing that we do is we don't have rational expectations of the macro agent. Instead, we have learning and adaptive expectations. And so agents will learn about trend inflation in particular. We'll call that pi bar T. This is their perceived trend inflations, using a constant gain learning algorithm. And there's evidence for this from Almendier and Nagel, and a backward-looking rule to form expectations for output. And this is actually all detrended output here. Perceived inflation, trend inflation, is not necessarily equal to the bank's inflation target. And the reason for that, you can think about that. Well, why would that be? Well, it could be equal to, according to, if our estimates want that, if the data want that, but agents don't directly observe the inflation target. One can think about it that way. And or central bank announcements are not viewed as fully credible or informative. So, you know, we will allow, that's what this is. So here's their perceived target. All of this stuff is from the constant gain learning algorithm. And this tells us, gamma tells us the speed, tells us something about the speed of learning about inflation. But there's also learning about the target. We will allow macro agents to receive a signal about the target. And so that's what this piece is. And it has a weight gamma t on it, compared to 1 minus gamma t on the constant gain learning algorithm. And it's, you know, gamma t tells us how informative the signal is and is related to the speed of learning about changes in the target. So if the signal is very informative, then gamma t is large and deviations of perceived inflation from the target are short-lived. And conversely, if gamma t is small, we will have persistent deviations of perceived inflation from the target. Okay, so these are, investors take these dynamics as given and form beliefs about the persistence of any regime shift in the policy rule. So this, you know, now the investor beliefs will be key, right? They'll be key to shifts in the stance, how shifts in the stance of monetary policy affect asset valuations and return premium. We will assume that investors closely monitor central bank communications so that they observe when shifts in the policy rule occur. However, they would be uncertain about how long any shift will last, and they would, in this model, have to learn about the duration of the shift. Now, why do we make these assumptions? Well, it's clear that market participants expend significant resources on Fed watching, so they're likely to understand when there's been a shift. Central banks also clearly telegraph their intentions when they want to seek a change in policy stance. But they're comparatively vague about how long such a change will last. And, you know, I've just clipped a couple of FOMC statements that, you know, you can look at in August 9th, 2011. Economic conditions are likely to warrant exceptionally low levels for the Fed funds rate for at least through mid-2013. And, you know, here's September 16th, 2020. The committee will aim to achieve inflation moderately above 2% for some time and expects to maintain an accommodative stance until inflation expectations remain well anchored. So these, you know, emphasized words are murky, and they explicitly convey uncertainty about the length of time any policy change will last. So, learning about the persistence of these regime shifts, we will model in the paper as beliefs about whether the regime is a short-lasting or long-lasting regime. So even though there's just a hawkish regime and a dovish regime in this, in the minds of investors, they might think that, oh, this is a short-lasting hawkish or a long-lasting hawkish. Now, this learning about the persistence of any regime shift and how long it will last is crucial for explaining a gradual sustained adjustment of valuation ratios after shifts in the policy rule rather than an abrupt one-time jump. We also allow beliefs to have a bounded rationality that is plausible in the presence of infrequent regime shifts. A fading memory of past policy rules. So long-lasting regimes come to be viewed as persisting indefinitely eventually. And, you know, I'll talk about the role of that later. But this all is modeled using the concept of perceived regimes so that expectations 8 steps ahead of the investor are fully characterized by recursive formulas that are given in the paper for the perceived regime probabilities. And I'll just refer you to the paper in the interest of time for those details. So we estimate this model using Bayesian methods. I shouldn't say under flat priors here. We use Bayesian methods. The flat priors are used for the Markov switching parameters here. And so these Markov switching parameters of the policy rule, the inflation target and the activism coefficients. You know, we freely estimate those under flat priors because, you know, in principle, the model could show that there is no regime change in policy rule if the data wanted that. Now, we also insist that the implied expected inflation process for the households be consistent with observed household inflation expectations from the University of Michigan survey of consumers. And so for data, we're using GDP growth, inflation, the federal funds rate, the mean of the University of Michigan survey of consumers inflation expectations, and the CAY wealth ratio. What do we find? Well, one thing we find is there are indeed big shifts in the conduct of monetary policy as measured by these parameters. With the high valuation, low MPS regimes, we call these the dovish regimes, those coincide with dovish policy rules. And the low valuation, high MPS regimes coincide with hawkish policy rules. What's a dovish policy rule? It's a rule with a high inflation target and low activism on inflation, deviations from target relative to activism on growth, while the hawkish rule is just the opposite. Low inflation target and a lot of activism on inflation, deviations from target relative to that on growth. We just point out that the model implied series track their empirical counterparts well. So we do a good job of explaining, in particular, the federal fund, the real Fed funds rate, which will come up later, right? All of these variables. There's the nominal rate and expected inflation. So we're getting the real rate with very little measurement there. Okay, so this is telling you about investor beliefs. And I, don't have a long time to talk about this, but, instead of just showing you the cursive formulas, here's how investor beliefs actually evolve over the sample. So what are we showing you here? The left panel reports the perceived probability of being in the long-lasting hawkish regime. That's the blue solid line in the top scale. Or the long-lasting dovish regime, red dashed line in the lower scale. And the right panel reports the perceived probability that we estimate of being in either the hawkish long or short lasting regime at T plus H, where H is 1 quarter, 4 quarters, or 80 quarters in the future. And then we just initialize the asset pricing agent's belief in 1960 Q1 at the beginning of our sample, assuming that she assigns probability 1 to being in the short lasting dovish regime. So what do we see? Well, it takes several years of continuously observing dovish monetary policy before the perceived probability of being in a long-lasting dovish regime reaches 1, and that takes about a decade. And then if you look at this graph, what this is saying is when we switch to the hawkish regime under Volcker, the agent initially places low probability of the switch enduring. So we can see that the perceived probability of remaining in that hawkish regime in 1 year's time is only 20% initially. It does then rise and reaches this very high level after some number of years. This history dependence there is in the evolution of beliefs implies that in 2006 Q2, when we switched to this brief hawkish regime, there's a recent memory of a long hawkish subperiod here. And so agents move much more quickly to believing that they're back in a long-lasting hawkish regime. So there's this interesting history dependence. But this is how the beliefs of the investor are evolving. Now, what is happening with the macroeconomy across these regimes, according to our estimates? So the blue line is showing the simulation of the baseline model where fluctuations are due only to changes in the policy rule. The red line is showing a counterfactual where the policy rule never changed. And then the black line shows another counterfactual, what would have occurred if there had been changes in the inflation target, but no change in the activism coefficients. So what do we see? Well, I mean, first of all, perhaps not too unsurprising, perhaps unsurprisingly, if the central bank had not shifted to hawkish under Volcker, inflation would have just kept rising. And this, by the way, is a simulation where the observables and estimated state vector are taken as they were at the beginning of the sample, and all the Gaussian shocks are shut down. So the only source of variation in the blue line is changes in the monetary policy rule. So under this counterfactual, they don't change. There's no change in the policy rule, and then the system just evolves and inflation keeps rising. The hawkish regimes under Volcker and pre-Great Recession are contributing to sharp contractions, and that's what these deep blue dips in the blue lines here tell us. And for the real interest rate, we see big swings in the real interest rate that are attributable to regime changes in the conduct of monetary policy. So especially a big increase in the real interest rate in the Volcker hawkish regime. If we don't have shifts in the activism coefficients, these black dotted lines, compare them to the blue ones, we see that there would be smaller fluctuations in real variables, right? And growth would have contracted less, but inflation would have been higher throughout the rest of our sample. Now, if you don't have sticky expectations about the inflation target, right, if we counterfactually shut down the fact that inflation evolves with this slowly moving constant gain learning algorithm and just allow long-term perceived inflation of the macro agent to move with the inflation target, well, then inflation would jump immediately to the target and there would be no change in the real interest rate at all or in any real variable at all. Okay, so this stickiness in inflation expectations is really crucial to getting real variables to move around in the face of changing monetary policy conduct. So let's take a look at a prominent episode, start the economy in 1980 Q1. That's the peak inflation, but before the peak of the real interest rate, and shut down all the Gaussian shocks. And what do we see here? We have the data, again, for inflation, the Fed funds rate, and the real interest rate. And then we have what happens, according to our estimates, if the only thing that changed was the policy rule over the sample. And, you know, what happens is you get large, low frequency movements in the real rate. And most of its downward trend since 1980 is attributable to changes in the policy rule itself. Of course, there are other shocks going on in the economy. We match the rate exactly. So the other shocks are contributing to these low dips. They're themselves kind of persistent, but this trend downward is coming in decent part from the policy rule. And in fact, the monetary policy regime shifts themselves explain about 2/3 of the decline in the real interest rate since the 1980s, and that's something you can see clearly in this graph. Now, what about policy shocks? You know, normally we think about the policy shock. So we think about the monetary policy shocks. So here I'm going to show you some impulse responses to policy shocks first, and then compare them to changes in the conduct of monetary policy. And so the top row, we look at cases involving curbing inflation, which means responses to policy shock show the evolution of variables in response to a 1 standard deviation contractionary monetary policy shock and no regime change. And then when I show you responses in the policy to a change in the policy rule, those will show the evolution of variables in response to a regime change from dovish to hawkish. So that's the curbing inflation case. All the Gaussian shocks are shut down. And conversely, in the bottom row, the lifting inflation, we're looking at responses to contractionary policy shocks and responses to changes in the policy rule going from hawkish to dovish. Okay, the textbook New Keynesian model is just the Gali model with a parameterization from Ludvigson and And so let's look at that first. What do we see? The textbook New Keynesian model, we get transitory effects on the real interest rate of, say, a contractionary or expansionary monetary policy shock, very short-lived, and that leads to basically negligible effects on asset valuations, as we see here. Now, in the BLL model, we also have policy shocks. And so what do we find? Well, policy shocks have smaller impact effects. Just let's look at the expansionary policy shock case. But they persist longer. And that's due to the sticky macro agent expectations. But, and notice that this then leads to a larger effect on the wealth ratio compared to the case where you don't have sticky macro agent expectations as in the textbook New Keynesian model. This underscores really the crucial role of persistent monetary non-neutrality for generating big changes in price levels or ratios of price to fundamental value. And you can see that it's not the impact effects, not so much the size, but how long it persists that matters. Now, this isn't very big. Even the red line, right? Even so, it's bigger, but it's not very big. If you now look at deliberate shifts in the stance of policy, these are far more long-lasting and thus have larger effects on asset valuations, and you can see that here. All right, so big persistent change in the real interest rate lead to big persistent changes in the wealth ratio. And these are very long-lived effects on the real interest rate and the wealth ratio. In fact, on the real interest rate, the half-life is more than 90 years of a change just in the policy rule, according to these estimates. Now, monetary policy shocks, why do they cause short-lived effects? Well, because they cause inflation to move away from target and are always quickly stabilized, even in the BLL model and even in the dovish regime. It's sort of, by contrast, a truism that deliberate changes in the central bank policy rule are not stabilized. And so the extent to which regime changes in monetary policy persist in their real effects simply depends on how quickly agents adapt their expectations about long-term inflation. And since our parameter estimates imply that the macro agents' expectations or macro expectations from the surveyed consumers adapt very slowly over time, changes in the conduct of monetary policy have effects that last for decades. Okay. So what about monetary policy and asset valuations over time? So here we're plotting again the monetary policy spread. The black line is the data line and the wealth ratio. And this is repeating from before. Here are our regime means again: high, low, high, low, high, low for the monetary policy spread. Conversely, for the wealth ratio. The red line here now is the fluctuations due solely to regime changes in monetary policy under the baseline model that we estimate. And so what this says is that the model implied variables fluctuate closely around their data regime. It's the only thing that regime means. If the only thing that changed was the policy rule, we would basically get the pattern in the monetary policy spread and in the wealth ratio that we have seen in the data. The large swings in asset valuations that we see coincide with these persistent shifts in discount rates that are attributable to the conduct of monetary policy. And this learning aspect delivers this gradual adjustment of valuation ratios after we switch, though it really is history dependent. So how gradual it is does depend on the history of what has happened, as I remarked on earlier. So what are the lessons so far? Large movements in asset valuations following monetary policy regime changes are the result of an interaction between two forces: sticky macro agent expectations about inflation in particular, and revisions in investor expectations about the conduct of future monetary policy. If we didn't have the sticky macro agent expectations, we cannot generate persistent changes in the real interest rate that in turn trigger the large changes in the wealth ratio. And without investor learning about the persistence of regime shifts, we get impossibly large jumps in valuation ratios all at once at regime shift dates. So that's what we've learned so far. What about return premia? This is a plot of our estimated PDV of future return premium that I already showed you. And the component of the real interest rate that fluctuations that's attributable only to monetary policy rule changes, right? And that's what this blue line is, according to our estimates. And so you can see the positive co-movement between return premium and the component of the real interest rate attributable just to the monetary policy rule changes. Dovish policy lead to low return premium or correlated with low return premium and vice versa. Now, the correlation between the PDV and this component is 81%. Correlation between the PDV and the residual is 9%. You sum up to the total variation. And since we're matching the real interest rate variation exactly, what is this telling us? Well, deliberate shifts in the monetary policy stance play an important role in this co-movement, but changes in the real interest rate due to other shocks do not. All right, so how does the model explain all this? Well, this gets to this fading memory distortion, which is a form of over-extrapolation. You know, we have estimate the parameters, but we also impose certain aspects on certain parameters so that the investors, if they haven't seen a regime shift in a while, eventually they come to believe that the current regime will continue indefinitely. So, of course, in reality, regime shifts are persistent but not permanent. Over-extrapolation from recent events has precedence in the literature, and I mentioned several papers here. With over-extrapolation, what we have are valuation ratios that overshoot the case where the agent will be fully cognizant of the true transition matrix. And so this has implications for the PDV of equity return premia across regimes. So if the model generated the data, then an econometrician armed with historical data and estimating a Markov switching bar, as we've done, to compute the PDV of return premium, would be able to detect this overreaction, looking back on the sample, and find predictable changes in return premium across monetary regimes. And so that's exactly what this shows. So this is just the monetary regimes of return premium in the model and from a simulation, right? So we simulate the model at the posterior mode parameter values 20,000 times, and then we estimate on simulated data a Markov switching bar. We compute these PDVs, and the figure reports at each point in time the average across simulations of the PDV and the wealth ratio implied by the model and the real interest rate in the right pane. And since we average across sample paths, the observed movements in the CAY and the interest rate are attributable solely to regime changes in the policy rule. And so what this is just telling you is that the PDV is high according to the model in regimes where the wealth ratio is low. You see that here. And it's high in regimes when the real interest rate component is high, that's attributable just to monetary policy. And we take the simulated data, compute the posterior probability that the PDV is lower in the dovish regime, and we find 0.73, which is close to our empirical estimate of 0.81. Okay, I don't have much more time here. Let me just tell you about our future steps. And, you know, I didn't really have time to get into the event study that we did, which I do have slides on. So if people are interested in that, just how the stock market reacted around the Fed announcements during March and April of 2020. But, you know, much of the motivating empirical evidence, here's our next steps that we've been talking about at the very beginning was from central bank announcement effects, right? So what news is in the monetary policy announcements and how is it related to evidence of persistently shifting policy rules? This is what we're working on now. And so our new work will assess the hypothesis that announcements cause jumps in beliefs about the future conduct of monetary policy. And these beliefs take the form of revisions and expectations of how long the current policy regime will last versus switching to some alternative model that agents might have in their mind, and we can estimate what that looks like. So I think this would be the first attempt that I'm aware of to sort of import into an actual model high frequency event study into a structural macrofinance model. Well, this will require extending our model, our data, and our estimation. And that's what we're working on. So I have some more motivating slides for how the market reacts to these kinds of things. And I also have a few slides on the COVID event study that we did. But, you know, it's already, I think we've been talking for an hour. So let me stop here. I'm happy to talk about this event study or anything else that people might have in mind. And let me see if I can, if there's so what did we decide we were doing? Participants want to ask a question, you can raise your hand, and I guess I have to unmute you. If no one has a question, I can just sort of keep talking, but please raise your hand if you have any questions. We can just have a quick discussion on anything that I've talked about. I know I've thrown a lot at people. I'm not sure if I can actually see people raising hands. Okay, there's one hand here. Okay. Please unmute yourself and ask your question. I've tried to ask you to unmute. Hopefully you can ask Al Sanders. Can you unmute yourself? If you have a question. Okay. I thought Al Sanders had a question. Let me ask someone else. Hi, can you Hi, can you, yeah, there you go. Go ahead.
Yeah, hi, hi, sir. I have a simple question. Has your study captured QE programs and its effect on capital markets? So, how have QE programs, which are now popping up across the world since the last recession, and how is that captured, and how can that affect the capital markets in the long term? Thank you.
Thank you. So in the model that we have it's a good question. So in the model, we have to simplify things somewhat. And so the policy rule, the way QE would show up in the policy rule is effectively through changes in the target, right? And changes in their objectives, without actually modeling a separate argument in terms of QE. But you can imagine, changes in QE that are in response to changes in the economy that show up as, for example, a really high inflation target. Now, literally speaking, because our model has, these sticky macro expectations, and that's what the data seem to suggest for households, the target never actually gets there. That's sort of in the absence of shocks, right? But if you just look at what the target would be in the absence of shocks, say post Great Recession, you would see something in our model that looks like an implicit target that's very high. And part of that would be the capturing the unconventional monetary policy changes. So in the model and in the estimates, that's how it shows up. It shows up as sort of pronounced changes in the target over time. So, Great Recession, our model says if you didn't have any shocks, you would have seen a very high inflation target. That's partly addressed through these QE policies to hold down, interest rates for an extended period of time and control, expectations about the future. In the new work that we're doing, we will also be looking at announcements, all FOMC announcements, and those announcements will be permitted to potentially have an effect on agents' beliefs about changes in the policy rule and how long it will last and what's coming for the interest rate rule. And, if you think about the recent announcements from the Federal Reserve, they've linked changes in the policy rule or changes in their interest rate policy to their other sorts of QE policies, the unwinding of their asset balance sheet on their asset. So, you can imagine how an announcement regarding QE would also potentially affect what people believe about how long they're going to be in the interest rate policy rule. We'll be able to directly capture that. Thanks for the question. Does anyone else have a question? So I don't know how long these things typically last. I guess other people have potentially done these things. So I don't know if we should just continue, like, is this session running to 9:30 or, sorry, 7:30, 8:30, 9 o'clock, or is this session supposed to end whenever questions end? But, I'm happy to say a bit about this event study, but if, I don't have to either. (10:33) my time, 8:33 your time. Well, one of the event organizers did ask me to speak about this. So let me just quickly go through this, and then I'll ask one more time for questions, and then we can wrap up, since I don't see any questions right now. So, I did this study with Josue Cox and Dan Greenwald as part of a paper that uses another model and tries to think about, how do we explain the sharp V-shaped response to in the market, this V that occurred in March February and March, and then this big recovery. So we did this high frequency event study to try to figure out, did the Federal Reserve have anything to do with this? And, you know, we looked at the behavior in the minutes, behavior of the stock market in the minutes surrounding the Fed communications in March and April, all of their communications. We separated out announcements that were about conventional policy and unconventional policy. By conventional policies, I mean, you know, policies to lower the target Fed funds rate and just increase holdings of Treasury and agency-backed MBS. Unconventional tools include some that were used previously in the Great Financial Crisis that were sort of dusted off and reopened, you know, to stabilize funding markets, reopening credit facilities previously used in the Great Financial Crisis, as well as during COVID, the COVID crisis, the Fed broke entirely new ground by announcing new facilities to lend directly to non-financial firms and non-financial entities like households and governments. And so we separated these out and we looked at the Fed announcements regarding actions to address the COVID-19 crisis. By discretizing the sample into 10-minute intervals, we used as a baseline the stock market value 10 minutes before an announcement and compared it with 20 minutes after. And we also looked at news reports very carefully because there's obviously a lot of fast-moving news during this period of time about the coronavirus, and to try to understand whether something else in these tight windows could be driving the market besides the Fed announcement. And so we sort of isolate announcements that are plausibly attributable only to what the Fed was saying in that tight window. So what this is just showing you is the effects of the conventional policy announcements. And, you know, we're looking at a sample that's just January 1st of 2020 to May 5th of 2020. So, you know, it's not a long sample, but we have a lot of observations because we're just looking at these 10-minute intervals. And then we're just looking at what is the effect in the 10-minute intervals of these announcements. And that tells us the effect on the market using sort of an event study. But what we see are the total impact of the policy over the 30-minute windows, that using the baseline 10 before and the sum of what's happening all throughout the two 10-minute windows after. We see that the conventional policy didn't even spur the market. In fact, it combined to cause a 17% decline in the market. Now, you know, with the exception of the March 3rd announcement, all of these announcements are associated. There were announcements of conventional policy here associated with the decline in the market, right? So, you know, of course, that doesn't mean that the Fed caused the decline in the market. In the case of March 15th, for example, the lowering of the target rate range for the Fed funds rate to 0 to 0.25% seems only to amplify worries over the virus, the extent of the damage from the pandemic. That's what we pick up from news reports. Now, a second series of announcements said that the Fed would revive and/or expand credit facilities previously used in the 2008 financial crisis. And, you know, on March 23rd of 2020, the Fed began the first of several communications on the creation of credit facilities that were entirely new to the COVID-19 crisis. So designed to extend credit directly to non-financial entities, that is corporations, to small businesses, to households, and to state and local governments. That went well beyond the 2008 playbook. There were quite a few announcements, and I'll just mention one. On April 9th at 8:30 in the morning, the Fed announced it would take additional action to provide $2.3 trillion in loans to support the economy. And we're going to just classify all these as unconventional monetary policy announcements. And what's immediately clear from looking at all of them is, you know, not all of these announcements to address the economic costs of COVID-19 were associated with a rise in the stock market. We see some negative signs in there. Indeed, among the unconventional policy announcements, there are at least 4 for which there's little to no evidence that they served as an impetus for a market rally. And when we look at news reports, you know, at least 2 of these appear to have been preponderated by bad news about the virus. Others were widely anticipated, according to news reports. And so combined, if you take all the announcements, they have only a small impact on the market. And they would lift the S&P by about 1.5%, according to these estimates. But at the same time, there were 5 separate unconventional policy announcements about unconventional policy that we did find were associated with a rise in the stock market. Among these, this communication on April 9th to provide support of up to 2.3 trillion for the economy was through these new lending facilities is estimated to have the largest quantitative effect. You can see that here. And there are a whole bunch of new facilities that were either expanded upon or introduced. The Main Street Lending Program, the municipal lending facility were introduced. They expanded the primary and secondary market corporate credit facilities, expanded on the term asset-backed securities loan facility that had been in the previous announcement, provided new support for the Paycheck Protection Loans facility, and so on. Also, the March 17th commercial paper funding facility and the March 20th dollar swap lines with central banks were important quantitatively. And so collectively, you look at these numbers, these are associated with gains of approximately 8.3% in the S&P and maybe 12% in the Russell 2000. But of course we can look back on this now, and with the benefit of hindsight, we can observe how much credit the Federal Reserve actually extended under these facilities. And to do so, we referred to the Federal Reserve's periodic reports to Congress delivered on August 8th. And there was another report on December 11th of 2020. And so from those reports, we can observe that this is as of July 31st, 2020. The total value of credit extended under all of these new facilities was just 101 billion, right? The 2.3 trillion was pledged. The Main Street Lending Program, for example, which is some little tiny sliver in here, I don't even think maybe that's this one. No, it's even smaller than that. This one here, the Main Street Lending Program, had a total outstanding loans of only 87.6 million. That's million with an M. Even though the total value of collateral pledged to secure those loans was 37.6 billion. So by November 30th, the total value of these had shrunk to 86 billion, and with the Main Street Lending Program shrinking to 6 million. So as we now know, the market has only continued to climb over the summer and the fall of last year. And so what do these results suggest? And, the Fed announcements about new credit facilities specifically did seem to play some role, according to the event study, in the market turnabout. But somewhat ironically, it did not do so via a substantive extension of credit to support the economy. And there's little evidence from the high frequency event study that the traditional monetary policy steps were an impetus for a market rally. So what could be going on? Well, this brings us to the froth in the market more recently. If we look at, there's several, we consider 2 possible explanations. There have been rallies in the bond market as well, in investment grade and high yield bonds recently. And it's a paper by Hansen, Stein, Suderam, and Zwick, HSSZ, go into this. And they show that in response to the primary market credit, corporate credit facility, and secondary market corporate credit facility announcements, there have been these sharp rallies, even in the high yield bonds, despite the terms of these requiring the bonds to have an investment grade rating, and that high yield spreads as of August 2020 were below their average over the past 25 years. So, what's an explanation for this? And then there's the froth in the stock market as well. Well, HSSZ speculate that the bond market may be misperceiving the Fed's current intentions to intervene in the bond market going forward. Perhaps misperceiving that they intend to rescue fundamentally insolvent firms, and that could be part of what's going on. Now, for BLM, this stuff that we're working on, we're going to entertain the notion that the stock market might be perceiving an intention by the central bank to remain crouched in an incredibly dovish stance for a prolonged period of time. You know, the conventional monetary policy announcements, as we've seen, were not an impetus for a market rally. Those are likely perceived, which we'll be able to estimate, as a prototypical cyclical response rather than a paradigm shift. But when you're talking about announcements of the form, and this was in J. Powell's May 29th, 2020, we're going to do whatever we can for as long as it takes. It's possible that these kinds of announcements are creating the perception of a paradigm shift in the conduct of future interest rate policy. Okay. Let me just conclude here, and I'll take more questions. What have we done? We have, if there's questions, the U.S. economy is characterized by large, longer-term regime shifts in asset valuations, concurrently with big and persistent shifts in this monetary policy spread. Variation in the real Fed funds rate around a measure of the neutral rate. Now, we asked ourselves what part of this can be attributable to monetary policy. To answer that, we solved and estimated a novel macrofinance model of monetary transmission. The estimates tell us that the conduct of policy differed markedly across the persistent MPS regime subperiods. In the model and in the data, these subperiods that have dovish, also have dovish policy rules are times of persistently low monetary policy spreads. And conversely, for they have high stock market valuations and low return premium, and conversely for the hawkish rules. So this model provides a rationale, its estimates provide a rationale for how monetary policy can have long-lasting effects on the real economy, on equity markets, and on return premium. And the model and its estimates speak to the origins of persistently declining real rates over 40 years. And one striking finding I'll just leave you with is that the estimates imply that 2/3 of the downward trajectory in short-term real rates since the early 80s is attributable to regime changes in the conduct of monetary policy. Let me stop sharing. It's harder to see anything. I will welcome any more questions from anyone if they want to raise their hand.